5 assets that go to absolute zero. Not 5 assets that dip, not 5 assets that underperform, 5 assets that become worthless while you watch. And the most dangerous one isn't in some exotic corner of the financial system. It's sitting in the most conservative part of your portfolio right now, exactly where your financial advisor told you to put it. Here's what the conventional crash narrative gets completely wrong. People think a crisis means stocks fall 30%. You hold tight, you ride it out, everything comes back. That's a correction. That's a bad quarter. That's the kind of thing CNBC covers breathlessly for 6 weeks and then forgets. What I'm talking about is a different category of event entirely. Argentina, 2001. Greece, 2010. Lebanon, 2019. Weimar Germany, 1923. The kind of crisis where your account statement still shows the same number every morning, but that number has quietly stopped meaning anything. The kind where the rules of money themselves get rewritten overnight and nobody sends you a memo. Most financial advice is engineered for the first kind of crisis. It will not protect you in the second kind. Because in a genuine economic collapse, certain assets don't just lose value. They undergo purchasing power annihilation, and the exit doors close faster than anyone expects. By the time most people realize what's happening, the decision has already been made for them. Here are the 5 assets that history has executed, the mechanism behind each failure, and what the forensic record actually shows about who survived and who didn't. The used car lots of Buenos Aires in December 2001 tell you everything you need to know about the first one. Argentina had just defaulted on $93 billion in sovereign debt. The peso, pegged 1-to-1 with the dollar for a decade, was about to collapse overnight. Banks were frozen. Cash machines were empty. And on those lots, 3-year-old BMW 5 Series cars that had been holding 60% of their original value were moving, when they moved at all, at 15 to 20 cents on the dollar. Not because the cars had changed, because the pool of people who could afford to buy them had effectively ceased to exist. Luxury durable goods, designer watches, high-end vehicles, boats, collector items, derive their value from exactly 2 things: discretionary income among buyers, and a social environment where status signaling still functions. In a genuine economic collapse, both of those conditions evaporate simultaneously. Everyone who might buy your Patek Philippe is also liquidating their Patek Philippe. Supply floods the market at the exact moment demand disappears. And unlike productive assets, a luxury watch generates no income while it waits for a buyer. It just sits there, worth less every week. The 2008 financial crisis showed the same pattern at scale even without a currency collapse. The secondary market for high-end watches fell 40 to 60% within 18 months. Luxury vehicles depreciated at twice their normal rate. Boats across Florida's marinas were being abandoned outright because owners couldn't find buyers at any price and couldn't afford the docking fees on something unsellable. Adam Ferguson's documentation of Weimar Germany puts the human face on this. Families trading grand pianos and fur coats for a single week of groceries. Antique furniture that had been in households for generations, exchanged for potatoes. The objects hadn't lost their craftsmanship. They hadn't lost their beauty. But beauty doesn't feed children, and in a collapsing economy, the only things with reliable exchange value are the things that address immediate biological need. The trap is that luxury goods feel like wealth. They look like wealth. They photograph like wealth. But they are consumption wearing the costume of investment. And in a crisis, that costume comes off faster than almost anything else you own. The phrase risk-free asset is one of the most expensive lies in the history of financial marketing. There is no such thing. What the phrase actually means is risk-free for the government. For you, it describes precisely the opposite of what it promises. Here is the contract you're signing when you buy a government bond. You give the state your money today. The state promises to give it back in 10, 20, or 30 years, plus a fixed rate of interest denominated in the state's own currency. That sounds conservative. What it actually means is that your return is entirely dependent on that currency retaining its purchasing power over decades. And governments under financial stress have one overwhelming incentive: to make that currency worth less, quietly and gradually, so the debt they owe you shrinks in real terms without them ever having to formally default. Greece in 2012 didn't bother with the quiet approach. It went straight to the explicit haircut. Private bondholders, pension funds, retirees, ordinary savers, who had been told their entire lives that government bonds were the safest place for money, lost 53. 5% of face value by government decree. Not gradually. One announcement. Half gone. The people most devastated weren't speculators. They were the people who had been most obedient, most conservative, most trusting of the conventional wisdom. But Greece was loud. The more common method is silent, and it has been used by every major government in modern history, including the United States. After World War II, U.S. debt to GDP hit 119%. The government's solution was not to default, not to raise taxes enough to pay it down, but to hold interest rates artificially below the inflation rate for over a decade. If you bought a 10-year treasury in 1945, yielding 2, 5%, while inflation averaged 6%, you lost 3. 5% of purchasing power every single year. The government paid you back every cent it promised. The money just couldn't buy what it used to. That is not a default. That is something more insidious, because it carries no political cost and leaves no visible wound. Argentina's bond collapse in 2001 destroyed $82 billion in bondholder wealth. Russia's 1998 domestic default wiped out the entire internal bond market in a single week. Venezuela's bonds became wallpaper. The pattern across every case is identical. When a government's debt becomes unsustainable, bondholders are the first casualty and the last to understand why. Long-duration bonds are the most exposed because they lock you in the longest. A 30-year bond purchased at a fixed rate in an inflationary environment is a 3-decade commitment to watching your purchasing power drain away, with no exit that doesn't crystallize a loss. The risk-free asset is a trap. It just runs in slow motion. Cash is king until the kingdom falls. In a normal economy, holding cash is prudent. Liquidity gives you options. But in a genuine currency crisis, cash doesn't just underperform. It ceases to function as a store of value at all. It becomes a melting asset, and the melt accelerates the longer you hold it. Beirut, October 2019. The Lebanese pound had been pegged at 200 to the dollar since 1997. 22 years of apparent stability. Lebanese families trusted the peg. They held savings in pounds. They deposited lifetime earnings in Lebanese banks. A family with the equivalent of $100,000 in savings was being financially responsible by every conventional measure. By 2023, that same account balance represented approximately $1,185 in purchasing power. The number in the account hadn't changed. 98. 3% of what it could buy had simply ceased to exist. This is not an investment loss. No decision was made wrong. No risk was taken. The money was sitting in a savings account doing exactly what it was supposed to do, while the unit of measurement it was denominated in was quietly destroyed by forces the account holder had no ability to influence or even monitor. The mechanism is always the same. Cash is a claim on future purchasing power denominated in a unit the government controls. When that government needs to fund deficits, service debts, or survive a crisis, the value of that unit is the first sacrifice, because it is the most politically painless one. The account balance doesn't change. No one takes anything directly. The purchasing power just quietly drains away while the number sits there looking reassuring. Weimar Germany made this visceral. Workers were paid twice daily because wages received at noon were worth measurably less by evening. Women ran from factories during lunch breaks to spend wages before the afternoon price updates made them insufficient. Venezuela's bolivar lost 9% of its value. Lebanon lost 98, 3%. Zimbabwe printed $100 trillion notes that couldn't buy a week of groceries. Cash is not wealth. Cash is a representation of wealth denominated in a unit someone else controls. The question is never whether your number is safe. It is whether the unit that number is measured in will still mean the same thing tomorrow. Not all equities are equal in a crisis, and this distinction matters more than almost anything else in your portfolio right now. Productive companies with real revenue, real exports, genuine assets, and the ability to adapt their cost structure can survive downturns and sometimes emerge stronger. But there is a category of stock that does not survive, has never survived, and the forensic record across every major economic dislocation is completely consistent on this point. Companies with no earnings, no dividends, no tangible assets, and business models that depend entirely on cheap capital and optimistic projections about a future that hasn't arrived yet. These don't just fall in a crisis. They go to zero. The mechanism is not complicated. Speculative stocks are valued on the present value of earnings that do not yet exist. In a crisis environment, two things happen simultaneously and reinforce each other. The discount rate explodes, meaning the theoretical present value of those future earnings collapses mathematically. And simultaneously, access to the cheap capital these companies need to survive, until profitability arrives, disappears entirely. A company burning cash while waiting to become profitable is suddenly unable to raise its next funding round. Without that round, it has no runway. Without runway, it dies, not weakened, not impaired, gone. Shareholders receive nothing. During the 2008 crisis, over 400 publicly traded U.S. companies went bankrupt. Washington Mutual, the largest bank failure in American history. Lehman Brothers, $691 billion in assets, wiped out. Shareholders in both received exactly zero. The Greek stock market fell 92% from its 2007 peak to its 2012 trough. An investor holding 100,000 euros in Greek equities in 2007 had 8,000 euros remaining 5 years later, and those were the companies that survived. Dozens were delisted entirely. Their shares worth literally nothing, not recoverable, not eventually bouncing back, simply gone. The lesson from every crisis economy examined over the past century is consistent. The first companies destroyed are the ones whose valuations required 30 years of perfect execution to justify. In a crisis, perfect execution becomes impossible, capital dries up, and the castle built on projected earnings discovers there was never anything underneath it. The fifth one is the one that has destroyed more middle-class wealth than any other asset on this list, because it is the one that the most people are holding the most of, with the most borrowed money right now. The misunderstanding begins with language. When you buy a house with a mortgage, you do not own a house. You own equity in a house. The bank owns the rest. Your equity is the gap between what the property is worth and what you owe. In a rising market, that gap grows. In a falling market, it compresses. And it compresses faster than most people intuitively understand, because leverage amplifies movement in both directions with complete symmetry. A 20% decline in a property purchased with a 10% down payment does not mean you lost 20%. It means you lost 200% of your actual equity position. You're not just broke, you are in negative territory, owing more to the bank than your asset is worth. That is called being underwater, and it is not a metaphor. It is a legal and financial condition with real consequences for every subsequent decision you can make. Between 2008 and 2012, U.S. home prices fell an average of 33% nationally. In Las Vegas, Phoenix, and coastal Florida, the decline exceeded 60%. Over 10 million Americans found themselves underwater. Between 2007 and 2010, approximately 8 million foreclosure filings were processed. But the number that the aggregate data hides is the cascade effect. Underwater homeowners couldn't sell without bringing cash to the table they didn't have. They couldn't refinance because the collateral was worth less than the loan. They were trapped making full payments on a depreciating asset while their income was simultaneously being compressed by the same contracting economy that had destroyed the property value. Greece saw property values fall 45% between 2008 and 2017. The government's response to collapsing property tax revenue was to raise property taxes, compressing owners who were already losing money on assets they couldn't sell. Spain was worse. Property prices fell 37% between 2007 and 2013. Over 500,000 families lost homes to foreclosure. Under Spanish law at the time, losing the home did not eliminate the debt. People were simultaneously homeless and legally obligated for the difference between what the bank recovered at auction and what they had originally borrowed. Homeless and in debt for a house they no longer possessed. So here is the complete picture. Luxury durable goods, consumption wearing the costume of investment, with no buyers, and unlimited sellers the moment real fear arrives. Long-duration government bonds and domestic currency. The risk-free asset that gets sacrificed first when the state needs to survive, through inflation, haircuts, or outright default, all of which extract the same wealth by different routes. Cash and cash equivalents in a weakening currency, not a store of value, but a claim on value denominated in a unit you don't control and can't defend. Speculative growth stocks, castles built on projected earnings that require cheap capital and perfect conditions, both of which disappear simultaneously in every crisis on record. Leveraged real estate, the asset that turns a market, decline into a mathematical annihilation of everything you actually own, while the debt you owe stays exactly where it was. Here's the thing that matters most, and it's the thing the financial industry never quite says directly. These assets don't feel dangerous during good times. That's not a coincidence. That's the trap. Safety is always a function of environment. A life jacket is safety equipment on a boat. It is dead weight in a desert. The question is never whether an asset is safe in the abstract. The question is whether it is safe in the specific conditions that are actually developing around you right now, whether you are paying attention or not. The warning signs that preceded every collapse discussed here were visible before the crisis arrived. They were visible in the debt ratios, the currency reserve levels, the bond yield spreads, the real estate price to income multiples. The people who came through intact were not the ones who reacted faster when things fell apart. They were the ones who had already asked the question everyone else was too comfortable to ask. If this changed how you think about what you're holding, subscribe. We perform financial autopsies here so you don't become the next case study.